Welcome to the Money and Investing Show. This space is all about managing money and kickstarting you into the world of investing and finance. A series of bite-sized episodes designed to simplify and equip you with the tools on how to get you started, along with some tips and tricks for those already investing. Stay tuned for today's episode with your host, Dale.
Hey everyone, and welcome back to our third episode now in our series of how to start your journey into investing. Today I am going to be taking you through understanding risk and how that can relate to different investment styles. So throughout today's episode, as I'm talking, I'd love for you to start to have a think about some of the things that match your personality and how it may help you in determining, which style might work for you best. Now, when it comes to risk and understanding it can be one of the best things you can do as an early investor to help you weigh up your decisions, steer your strategies, and manage any potential for losses. Now, I understand that risk isn't one of the most exciting topics in the world. I've actually got a mate that works in insurance, and believe me, nothing will put you to sleep faster than him describing his work. So I'll do my best to try and keep this interesting. And when I talk about risk, everyone is exposed to some type of risk every day. Now, whether that's from driving your car, walking down the street, or investing, there is always some type of risk to consider. And when it comes to investing, your personality, your lifestyle, and your age are some of the top factors to consider for thinking about how and what you will choose to invest in. To break that down a little bit further, when I think about a personality type for when it comes to risk, are you someone that likes to play it safe and are quite risk adverse, or are you someone that likes to live on the edge and, always take chances and go and do and see new things? So that'll really come into play when you start to think about the type of risk that you're open to. The next one is lifestyle. So where are you at in your stage of life, and what kind of lifestyle do you lead will also help determine the kinds of risks that you're willing to accept. So I know for myself personally that when my wife and I had our first child, some of the more risky stock options that I was involved in, I moved out of and sort of moved into a more midterm risk profile because I wasn't willing to accept the same sort of losses in the short term that could potentially have come from some of the more risky investments that I had. And I was now starting to think more about the future of my family. And obviously the last one is age. So we all know from what I've spoken about in previous episodes about the magic of compounding and how starting young is a really great way to get involved. But as you start to get later on in life, it's then about thinking about your exit strategies and how you get out of some of these options. And you also don't have that long time frame to recover if something goes wrong. So your tolerance to risk changes dramatically as you start to get older and you get closer to that retirement age. That's not to say that it's one size fits all and you can't do these things if you're one of those personalities or at that lifestyle or that age. It's just some things to consider when you weigh up risk. And to move on from there, I suppose fundamental to investing is really about understanding the risk versus reward concept, which essentially means that the greater amount of risk someone is willing to take, the greater the potential returns should be. A really good example of this is bonds. And we spoke last week all about bonds, but an example is a US Treasury bond, which is considered to be one of the safest assets in the world. You're basically lending money to the US government, who in theory should always be able to pay you back. So when you compare this to a corporate bond, you may find that the return is higher for a corporate bond. And this is generally because there's a higher chance of risk that the company could go bankrupt and you would not get any of your money back. So there's a big difference again, though, between borrowing from a company like Microsoft versus a startup that's looking to finance their growth. So, you've got a government, a large corporation, a medium corporation, and then a small startup. And with each of those, the risks are deemed higher and higher. And so the potential for return should be greater and greater as you take more of those risks. To think about the example of everyday risk that I mentioned earlier of just walking down the street, as we start to add more variables, we can then start to make a more informed decision of whether you think it's worth walking down the street or not. So, when you think about, is it day or is it night? Is the sun out or is it raining? Is there thunderstorms? What's the likelihood of me getting hit by lightning? Is it a crowded street or is it in a potentially bad neighborhood? And as I start to add in more of that information, I can now start to decide whether it's worth the risk to walk down the street or whether it's not worth the risk. And the same then works with investments. So the more information you use to weigh up your decisions, the more likely you are to understand the potential risks and be more comfortable with the decision that you're making. There are many kinds of risks to consider when thinking about your investment thesis. So I'll cover these briefly, but we might need a full episode to cover some of these others that could be in the future. So I suppose to start with, you have just your general business risk, like how is the company operating? What's their management style like? Are they doing good things with their cash flows? Are they investing for the future? What does all of those sort of things look like? Next up, you have things like credit or default risk. How likely is the company going to be paying back all their debts? Do they have the cash flows to be able to manage those levels of debts? Or, is there a lot of cash on the balance sheet? Next, there's always things like the country risk or the country that the company sits in. So is that country going to be able to face all their obligations? If they can't, that could really hurt a company that trades within that country, but it could also hurt a company that trades with that country from another country. So if they're importing or exporting goods and their country has something go wrong with their obligations, it can affect the company within that country. You then look at things like foreign exchange risk. If you're trying to invest in another country, so if you're buying stocks within America, what's the likelihood of the Aussie dollar either increasing or decreasing when it comes time for you to buy or sell? So there's something that you need to weigh up. There's interest rate risk. So how will rising or falling interest rates affect the business that you're looking at? Are they a highly leveraged business that rising interest rates could have a big impact on? Or, is their level of debt quite manageable? And when you look at a rising interest rate, it won't affect them too badly. You then come to things like political risk, and a really good example of that is in the US, where you're going through the elections, and investors were worried about when Biden came in, the sort of regulations he was talking about against the big tech companies, so things like Google and Facebook. So if you're worried about those sort of things, there's some risk involved there. And finally, there's always liquidity risk. So how easy it is to get in and out of the market. Are people frequently buying and selling the company that you're looking to get into? So something that has very high liquidity, people are trading very frequently, there's not a lot of risk that you won't be able to sell out. But if you're looking at something that's a little bit smaller, people don't necessarily trade so frequently, it's going to be harder to get out should something go wrong. The way I like to think about investment risk is how I would sleep at night knowing where my money is invested in a certain asset. So if the idea of high price movements and volatility have you concerned or would keep you up at night, then the investment might be considered too risky for you, and you might want to consider something with a lower risk profile. On the other side, if you've done all your homework and you're comfortable with the risks that you've taken and you understand that there's going to be some price movements, then potentially a higher risk profile could be for you. I like to balance out my portfolio where I've got some lower risk stuff, some medium risk stuff, and some higher risk investments. And I think for me that works because I'm comfortable that the higher risk things will move frequently, and some of the lower risk things are pretty steady and consistent. So, as you start to understand the risks and what you're comfortable with, that'll really help you plan out your investment portfolio. So now that you understand a little bit more about risk and where it can come from and how you view it and how you sort of analyze it, you can then start to think about what kind of investment styles would work best for you. And we'll cover a little bit more on that in next episode. But that wraps us up for today, guys. And I hope you enjoyed the content. And hopefully, again, you were able to take something away that's going to help you on your investment journey. As always, if you liked what you heard, please give the podcast a subscribe or leave me a review. I'd love to know what you think. And today's closing quote comes from Benjamin Graham, who once said, "Successful investing is all about managing risk, not avoiding it." Really good one to finish on today when we're talking all about risk. Hope you enjoyed the show, guys. Have a great week.
Please remember, the information and opinions provided in this podcast is general advice only and does not constitute financial advice. This podcast was created without knowing individuals' needs, financial situations, or investment objectives. The host of this show may hold positions in the companies discussed. Please remember, before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.